Today we have an extra treat. We have a guest speaker coming in, Herb Taylor, who's the Vice President Corporate Secretary of the Reserve Bank of Philadelphia. He's nice enough to join with us today and talk about, from a regulatory perspective, what's been going on, what his experience has been at the Fed and in general about what's going on in the economy. We already talked a little bit about the causes and consequences of the financial crisis last time, so I think it's a nice segue to do it. We have Herb Taylor from Philadelphia. Nice round of applause.
Thank you very much. Thank you very much. Thank you. It's very nice to be on campus here today and have the opportunity to talk to you a little bit about the Federal Reserve and the state of the economy and monetary policy, as well as a little bit about what I do at the Fed. This is when Professor Pagano and I talk, I realize this is a very special class. You all are well along your academic careers. Yes, that's good. And close to graduation, maybe. And you have this opportunity to think about what happens next in life and in career, given the academic background that you built up over your time here at Villanova. And I think that's a great opportunity, and I'm sure you'll take a lot away from it, because my own experience is that transition from academic life to a career and business life is a challenging one. I've been through it myself, obviously, and also my children, who are older than you all, have been through it as well. How many people here are economics majors? Great, good. So a lot of interest in that. It's not too late. It's not too late. Actually, how many people here are in the majors in the School of Business? How many from liberal arts?
It's a business school.
Right, okay, good. So nobody's visiting from over there in one of those other buildings. I went to LaSalle College, LaSalle University now. Tells you how long ago it was when I was there, LaSalle College, in the early 1970s. And I started at LaSalle as an English major. Taking all the courses that English majors take, the history of the American novel and all that kind of thing. Signed up as a freshman to take those classes. Wanted to take a course in medieval European history. Who wouldn't, really, when you think about it. And couldn't, tells you how different times were. This was, sort of Vietnam times, and people were more, sort of more into the liberal arts world. And so I tried to take this course in medieval European history, and I couldn't get in because the section was filled. It was completely filled. So my faculty advisor, each of us had a faculty advisor, and my faculty advisor happened to be in the economics department, and he said, I signed you up for a course in the principles of economics. And I didn't want to go. I just felt that it was a sellout. It would go into the business world and all that kind of thing. Took a course in macroeconomics. How many people had macroeconomics? There you go. Okay. I don't know about you, but I was absolutely fascinated. I had no idea what economics was about. I had no idea what issues the discipline addressed, how it proceeded. I had no idea. And I just found it to be the absolutely most interesting course I'd ever taken. And so I switched majors that semester and became an economics major. And stayed with that, stayed as an economics major at LaSalle. And then when I graduated from LaSalle, was a graduate student at Temple University in economics, and had the opportunity to, and again, so, I guess part of the story is, I found myself when I went to college in terms of what I wanted to do, and I hope that's true for all of you in terms of how it's going for you here. So I knew what I wanted to do after college. I wanted to go on and study economics further. When I was a graduate student at Temple, I had a professor there who had a friend who was engaged in a research project down at the Federal Reserve Bank of Philadelphia, one of the 12 Federal Reserve banks, as we'll talk about in just a minute. And the economist down at the Fed needed a research assistant part-time, so I went down and applied and got the job. I'm sure I wasn't particularly good at good at it, but as again, my professor at Temple had a good friendship with this guy. So I wound up being a grad student at Temple and also a research assistant at the Federal Reserve. And learned as much or more economics, of course, in the real world of the Fed as I did in the classroom. So I guess another big point about that story, about my story, is that you choose a career, you start down a path. You don't know what opportunities will present themselves, but they do, and you take them, and they lead you along some path. So here I am, having spent pretty much my entire working life so far at the Federal Reserve, and all because some faculty advisor back in 1970 said, "I'm putting you in an economics class whether you want to go or not." So that's just a little bit about me. There's another sort of irony about that, about switching over to economics, which I'll talk about later. But I thought I'd start out talking a little bit more about the Federal Reserve and the Federal Reserve System, just so you have some sense of who we are and what we do. Because I think there's a fair amount of interest in the Fed these days. As a matter of fact, I will tell you honestly that pretty routinely I have the opportunity to go out and talk to business audiences around the district, and usually I would go out and people might be interested in the Fed and this and that, but now what I find is that people suddenly want to work for us. It's a different kind of job market. In any case, the Federal Reserve System. The Federal Reserve is the nation's central bank. It's an unusual sort of a central bank in that it's a decentralized central bank. The Fed, the third attempt at central banking in the United States, sort of an indication of the political economy of the way the world works. The first Bank of the United States, founded during President Washington's time, given a 20-year charter, which was not renewed because people did not feel that it adequately represented domestic interests and felt that it was the tool of foreign interests. So his charter was not renewed, so that first central bank disappeared. By the way, for those Philadelphians here, been down to the Independence Mall area, seen the Independence Hall, seen Liberty Bell, walk over to 4th and Walnut, the first bank of the United States, which was the first central bank. So that was Philadelphia's home for the first central bank. Lasted 20 years, out of there. Then after the War of 1812, a second attempt at central banking, the second bank of the United States. We're beginning to see a pattern here. And of course, this is another 20-year charter, but again, distrusted. This time distrusted because people in the central part of the country and the western part of the country felt that the central bank did not represent their interests, but rather represented the big interests in the establishment of the East. And so President Jackson at that time led the charge to have its charter lapse, which it did. The second Bank of the United States goes out of business after 20 years. So after you stop at 4th and Walnut and see the first Bank of the United States, which is now a warehouse for the Park Service, you can go to 5th at Chestnut and see the second Bank of the United States, which is now a portrait gallery. So our bank, the Federal Reserve Bank of Philadelphia, is right by the National Constitution Center, and one of our presidents said that he likes walking by the first and second Bank of the United States and see that one's a warehouse and the other a portrait gallery. It's a sort of a reminder that if we screw up, we could wind up as a dry cleaners or something. But in any case, so a lot of history about, and I'll just mention because I'm at the Philadelphia Fed, if you happen to be down on Independence Mall and at the National Constitution Center or in that area, we have an exhibit on central banking and the development of the monetary and financial system in the United States in our lobby, and it's free to the general public. So you're always welcome to come by and sort of absorb some of history there. In any case, the Federal Reserve Bank of Philadelphia, one of 12 Federal Reserve banks spread out across the United States, and overseen by a board of governors in Washington. Each of the reserve banks individually incorporated. We each have our own board of directors, local business people and bankers who oversee our operation and participate in the monetary policy process. But we're all under the supervision of, again, the board of governors in Washington. The chairman of the board being, of course, Ben Bernanke, the chairman of the Federal Reserve. Everybody knew that, right? Okay. My mom keeps saying, tell that Bernanke guy to straighten me. But in any case, both of those characteristics, that there are 12 reserve banks spread out across the country and that were overseen by a board of governors in Washington, both of those characteristics are the result of a political process to try and establish a central bank that would last more than 20 years. Basically, remember the first and second banks were not rechartered because people didn't trust them to represent their interests. So the first thing that happened is that we created a Federal Reserve system so that there were reserve banks spread out across the country. This is 1913 when the Fed is created, so nearly 100 years ago. Again, in order to diffuse this controversy about which part of the country was being represented in monetary policy and Fed decisions, there were reserve banks set up across the entire United States, all the way from Boston out to San Francisco. Again, remember economic activity, again, sort of one of the lessons of economic history. Economic activity in the United States was more concentrated on the East Coast then than it is now. There was less in the Midwest, and far less in the West. Out here, just about, nothing, right? Just the Lone Ranger and Zorro and all those. Anyway, so basically the banks were more concentrated in the more populous areas, but as you can see, there was representation across the entire United States, and reserve bank districts were carved out to serve different segments of the country. So one feature was a decentralized central bank, so that a variety of the nation's geographic and political interests could be represented. And the second thing was that people didn't want the central bank to be the tool of the banking establishment in New York City, private bankers. At the same time, they didn't want the people in Washington to control everything either. So you have these central banks, each with their own board of directors, and then the government oversight provided by the Board of Governors in Washington. So there are 7 governors, each appointed to 14-year terms, each appointed by the President, each confirmed by the Senate. So there's government oversight of a system that has some independence across reserve banks. And that's the structure that was established in 1913. The Federal Reserve Bank of Philadelphia, how many people here are in Philadelphia area? Not so many, okay. So I don't know, how many people know what Federal Reserve District they're in? There's a lot of excitement. So you're in?
Cleveland.
Cleveland. There you go. We'll talk about that in a second. Okay, Cleveland's a good place. Anybody else know it?
Boston.
Boston, all right. That's interesting too. There's a lot going on there. Anything else? Any other districts people know about? Yes, sir. New York. New York. Okay, well, there's a lot of action in your district these days. Interestingly enough, when the system was founded, one of the conditions that they wanted to try to fulfill was to keep the New York banks from taking too much power, so they made the district really small. Which, anyway, but okay, so each of you comes from a part of the country where there's a Federal Reserve Bank serving you. And the reason I ask that is for a couple of reasons. But one is because when you ask what does it reserve banks do, they do a variety of things. One of the reasons the Fed was founded was to create something that we all sort of take for granted, which is a payment system that works efficiently across the country. We live in a monetized economy, so every transaction is a good or service flowing one way and money flowing the other. So you need an efficient system to move money around in its various forms if you're going to have an efficient and integrated national economy. And we didn't have one at the turn of the previous century. There was just not a uniform system for cashing checks, clearing checks, and there was not a uniform system. In fact, there wasn't any system for moving money electronically. So one of the reasons the Fed was created was to establish those means of electronic and paper payment, as well as to provide coin and currency to banks. So the reserve banks became sort of local service wholesalers, if you will, wholesalers of financial service to the banks in their district. So at the Federal Reserve Bank of Philadelphia, for example, as with all the Feds, we serve the full complement of the bank's needs. So we provide coin and currency to the banks in our district, and we clear checks on behalf of the banks in our district. So you deposit a check at your bank sends it to the, this is sort of the textbook story, your bank sends it to the Federal Reserve transports the check to the bank on which the check is drawn, collects the money from the check on which the bank is drawn, and puts the money in the account of your bank. So it moves money between your bank and whoever wrote you and the bank of whoever wrote you the check. Clears checks, that's what we do. In Philadelphia, we are part of a network of reserve banks across the country that, in principle, do this check clearing nationwide and even internationally. So we provide coin and currency, we clear checks, we move funds electronically. That is to say, how many people here get paid by electronic payment? You know, get paid, you all get paid that way, right? And my kids, well anyway, when my kids were in college, they sort of got paid by ATM. Like they would just go to the ATM and get my account. But, anyway, so we move funds electronically on behalf of companies paying payroll, or on behalf of the Social Security Administration making their monthly payments, and so forth and so on. And then we also move dollars, big dollar payments, on behalf of securities transactions, or big bank payments, or excuse me, big payments between banks, on the order of the average transaction on our big dollar network, the so-called FedWire, is about $5 million. So yeah, so these are big dollar transactions, and they move, of course, electronically. And we have actually been moving money on the wire since 1918, and so far we haven't lost any. These are scary times, though, so you never know what will happen next. But in any case, so we provide these basic payment services at the Philadelphia Fed on behalf of the banks that operate it, again, by being plugged into this national network. So we do that. We provide payment services. We are a bank regulator. It's a responsibility that we share with a number of other federal regulators. So if you know in the United States, you probably talked about this, that banks in the United States may be regulated at the federal level, either by the Comptroller of the Currency, if they have a national charter. If they have a state charter, they may be regulated by us, if they choose to, through the Federal Reserve System, or by the FDIC. One of the issues out there today is, of course, whether that's a good system, whether having an array of regulators rather than a single regulator may create the sort of the gaps in regulatory oversight that create the kinds of problems we've been experiencing. So that's something to think about. And then, of course, the third thing we do is we conduct the nation's monetary policy. That is to say, we make the decisions about how much the overall supply of money and credit can grow or contract in order to keep the economy moving. You've probably heard that the Fed has a particular monetary policy mandate that Congress requires that the Fed conduct a monetary policy that provides for a stable price environment and also maximum economic growth at the economy's potential rate. We'll talk about those things. But anyway, we have a monetary policy role, we have a bank regulatory role, and we have a financial payments role. And each of those roles is changing now. The system is 100 years old, and it's got the same, we have the same 12 banks, and we have the same overall structure that we've had for 100 years. But the way in which the system operates is changing over time. In the payments area, dramatic change, because the way in which people make payments is changing. And I'll ask you, how many of you write checks, paper checks? Really? How many of you never write paper checks? How many of people occasionally write paper checks? It's pretty mixed bag here. I'm surprised there are this many of you that write them at all, actually, because the volume of check writing continues to plunge in the United States. Right. How many people? See, this is how you really. I know I'm like a parent. How many people are asking their parents for it? There you go. I mentioned we have 12 reserve banks. The Philadelphia Fed is very typical in size, and very much like other reserve banks. We have about 1,200 employees. There are about 300 of them are involved in the payments system. In the check processing business. So think of that. I mean, 25% of our workforce is all they're doing is clearing paper checks. Paper checks come in at night, we ship them to wherever district they're drawn on, we collect the money, the next day. 25% of our workforce is involved in paper checks. The business is evaporating. 5 years ago, we had all 12 reserve banks and 25 other remote sites processing checks in the United States, 37 sites, 5 years ago. At the end of this year, we'll have one. And it will be in Villanova, home of the paper check. No. Sorry, I had like an issue about, you know this thing about Cleveland and Philadelphia, right? There's this issue about, I'm probably the only person with this issue, there were 2 finalists for the Rock and Roll Museum, Philadelphia and Cleveland. And I don't understand this. The Rock and Roll Hall of Fame, the museum went to Cleveland. We'll have some trouble with that. Anyway, but just think, the point I want to make is that you think of this as the Fed as sort of a venerable institution that has sort of unchanging over time. And yet the business, the management of our business is changing very dramatically right now. So we will shrink by about 300 people in Philadelphia just in the next couple of years. So that's one thing. On the regulatory front, as a bank regulator, you've already talked about this in class last week, I'm guessing, or earlier in the week, Professor Pagano, you talked about the current situation and the contribution of the current regulatory structure to the problems that have arisen. Interestingly enough, despite the fact that the Fed and probably other regulators, surely other regulators, share some of the responsibility for what's happened, if you ask what's going to happen on the other side of this, what will the political response be? It will almost certainly be to increase the scope of regulation over the financial services industry. And almost certainly the Fed will wind up with a larger rather than a smaller role in supervision and regulation of financial service firms. It just seems very likely. There is this sense that the underlying principle here is that there's not enough, the regulators did not take a broad enough view, did not understand the systemic risk associated with financial activities out there, and that somebody needs to take that broad view and be aware of the systemic risks and find ways to contain them. And probably the Fed's going to wind up with the role in that regard. We are already at our bank in Philadelphia beginning to see some of the ramifications of that. I mentioned that our payments department is shrinking. Our supervision and regulation area is starting to grow. Because it's just a practical matter. You notice that a couple of big investment banks, the way that they accessed federal money, access to the Fed's discount window, was to become commercial banks. Well, bank holding companies, right? So Morgan Stanley became a bank holding company as a way of getting access to the Federal Reserve. And so, you wind up in a circumstance where we have more organizations to oversee. And while the number of banks in Philadelphia, the number of large banks headquartered in Philadelphia is down to 0, while there are no big banks in Philadelphia, our supervision and regulation people take on the responsibility of assisting supervision and regulation people around the country. I was just talking to the head of our supervision area this morning, and he was saying that we're going to be picking up some business because Discover, which is headquartered in Chicago, has an operation in Delaware, which is part of our district, so our regulators will be out of that operation. So our supervision and regulation area is already starting to grow, just as a result of what's happening out there now, and it's likely to grow even more. On the monetary policy front, think about, I mentioned our bank's got 1,100 or 1,200 employees, 300 in check processing, another couple hundred in cash, so that's about half of our labor force, or a little less, is people in business. About 150, 200 people involved in bank supervision and regulation. Our role in monetary policy, which is the role that people hear about almost all the time, right? This is the Fed, we make monetary policy, that's what we do. Involves very few people, actually. It's a sort of, you might argue it's very efficient. As you know, the presidents of reserve banks, all 12 reserve banks, the presidents of reserve banks, along with the 7 governors of the Federal Reserve System, form the Federal Open Market Committee. This is the committee that meets every 6 weeks and makes decisions about monetary policy. Until December, monetary policy was summarized by our decision about where to place the federal funds rate, the rate of interest that banks basically charge each other on loans overnight, which we can regulate by and manage by supplying a certain amount of reserves out there in the marketplace. Federal funds rate is basically the price of reserves, and so by altering the supply, we can alter the price. So we manage the federal funds rate. We set a target for it. That's our monetary policy instrument. Every 6 to 8 weeks, the 12 Reserve Bank presidents and the 7 governors of the system meet at the boardroom at the Board of Governors in Washington. They spend a day or two, depending on the meeting. Number 1, reviewing economic conditions across the country. Number 2, considering monetary policy alternatives. And then number 3, making the decision about where to put the federal funds rate and what to tell the public about the decision. So now everybody waits until 2 o'clock in the afternoon on an open market committee meeting days to find out what happened. It is sort of exciting, it's amazing how much attention there is to the monetary policy decision. And so there's like the Federal Reserve building in Washington, which is sort of on the mall. It has the Federal Reserve's main building and its annex are facing each other on a narrow little street. And so all the reporters are on the sidewalk waiting for this announcement. And and the only reason I find it entertaining is because one time I had to go to a meeting at the Board of Governors, and it just so happened to be on the day that the Open Market Committee was meeting and there was going to be this announcement. So a taxi cab drives you up to the front of the Board of Governors building, and of course nobody knows who's in the cab. So when I get out, like all these reporters are rushing toward me, I'm saying like, wow, this is quite a meeting I'm having. Then of course they saw what it was. It was sort of, never mind, back to hot dogs and stuff. But anyway, but yeah, so a lot of fanfare about the Fed's monetary policy decisions. And they represent, that is an example of, I'll spend a minute on that. That's an example of the sense in which the Federal Reserve, while it's this decentralized system, brings all the pieces together when it comes to acting. So I mentioned that there are the 12 Reserve Bank presidents headed into the meeting and the 7 governors of the system. Each of the Reserve Bank presidents has used the time between meetings to collect intelligence about what they're seeing in the economy of their district. We do that in a variety of ways. So our president, again, meets with our board of directors. We have 9 directors. Again, 3 local bankers, 6 local business people, who are representatives of different organizations. Meet once a month in person, every other week by telephone. Big part of the meeting, what are you seeing out there? And we have people in some businesses that are really sensitive to what's going on in the economy and to movements over the cycle. So for example, among our directors, a guy named Keith Campbell who runs Mannington Mills. They're people who make flooring for both commercial and residential use. So you can imagine if you're asking yourself, how's it going in the construction business? Keith is a good guy to talk to because he knows exactly. And remember that he's going to tell us a couple of things that we're not going to learn by reading the statistics on housing starts. Because the statistic, for example, the statistic on housing starts came out this morning. Less than 600,000 starts at an annual rate. That was the number for December. The question is not what happened in December, but what happens going forward. So Keith will tell us, I'm going, this is a little bit, this is not literally true. I don't want to repeat, talk about his business in great detail, but he's saying basically, I'm seeing that across the nation, the layoffs that manufacturers put in place over the holiday, closing their plants for the holidays, a lot of them are not going to reopen, or they're going to go on shortened weeks from 40 hours to 32 hours in January and February. So you're learning a little bit more about what's actually going to happen, what's happening now, and what's going to happen next. So you're getting that kind of useful intelligence. Another of our directors, Gary Maddox. Anybody know the name Gary Maddox? Okay, so really I'm really old. Gary Maddox was the center fielder for the Phillies in the mid-'70s, and when the Phillies won the World Series in 1980, he was the guy. He was in center field. Anyway, Gary's now, he runs an office design business, and again, if you're asking what's going to happen to capital expenditures, ask Gary, because he's seeing it in his business, and he'll tell you his order books are drying up for 2009. So we get that firsthand intelligence. So the Reserve Bank presidents are bringing that kind of intelligence to the Open Market Committee meetings when they go. They're also bringing the analysis of their own economic research departments. It's, there's a certain advantage to having each president have his own economist to think about the economy in their own way, because there's so many points of view, and they all wind up being represented. So you have a diversity of both economic intelligence and economic points of view around the table when the decision is made. And again, the decision is made by vote, and at any one time, 5 of the presidents and 7 of the governors cast ballots. So the chairman of the Federal Reserve, Ben Bernanke, is trying to build a consensus around it, around a monetary policy decision. I'm looking around and realizing I've been talking for a really long time. Are there questions or comments or thoughts? Do you want to open the floor to that?
Yeah, I've got your questions. I think some nice questions here I've gathered as well, but maybe just in reaction to what Mr. Taylor said so far, has it sparked your interest?
Yes, sir.
Does each of the 12 reserve banks have like a similar proportion of the population? Like, it seems like San Francisco has a lot of people.
You're right. It reflects the distribution of economic activity and population in 1930. It's a lot different now. So in fact, like the Federal Reserve Bank of San Francisco, for example, you can see, covers everything west of the Rockies. They're huge in terms of geography, economic activity, population. So yeah, it's not representative in that sense. And you're raising an important question, which is, why don't we change it? Why don't we redistrict to reflect the changing economic landscape of the country over the last few years? And I think the answer is primarily political. If you reopen the question of where the reserve banks are, then you're going to wind up with the question of not just where we have built, where will the new ones be, but who's going to lose them? No one wants to lose, their Federal Reserve Bank. So the system is sort of locked up by the fact that there's a reticence to reopen the issue and impart losses to some community. So it stays the way it is. The second thing that's important is that the system was designed so that monetary policy decisions were made by the Board of Governors, who are federally, appointed by the President, confirmed by the Senate, public officials, and Reserve Bank presidents, who are appointed how? By their local boards of directors. So the question is, if you have monetary policy decisions being made on behalf of the country, and it makes sense to have public officials weigh in, does it make sense to have individuals who do not come up through the presidential appointment, Senate confirmation process? That's another sort of issue. So this issue about where the banks are and what their role should be is one that is constantly hit up. But again, there's this political issue that no one wants to reopen the discussion for fear that someone will lose. So yeah, it doesn't. So it doesn't reflect. That's a long answer to it. Doesn't reflect, and it's not likely to change, obviously. But the fact that the physical size of the bank's operation and the number of employees in the bank's operation are shrinking may change the politics of that over time. It's one thing if you're in Philadelphia or Pennsylvania to say, I keep an operation that employs 1,200 people. It's something else if it's an office building with 300 people. It's a different ballgame. Other things. Observation. It's sort of. Yes.
If I'm looking up economic data, sometimes I'll look at the Fred database if they have in St. Louis. So do the other branches ever have their own special functions like that for research or anything else?
They do. That's good. I'm glad you raised that. I mentioned that each reserve bank has its own staff of economists. They have their own points of view. And that also means that the different reserve banks take a different tack to approaching the collection of economic data and the dissemination of economic data. If you go to the website of any reserve bank, you'll find links to the reserve banks, other reserve banks' websites, and the Board of Governors' website. And you'll find that each of them has a different collection of information. At Philadelphia, we have a couple of things that others don't have. For one thing, we have what is called the Business Outlook Survey, which is a survey of district manufacturers. And over time, that particular series, all we do is ask manufacturers in the 3rd district, do you see your business going up or going down these days? And we take the number that say it's going up and we subtract off the number that say it's going down. We get what is called a diffusion index of economic activity in manufacturing in our district. And it's turned out that that's, over the last 30 or 40 years, been a pretty reliable indicator of national business cycles. So very often on the 3rd Thursday of the month, if you look on the financial news, you'll see the Federal Reserve Bank of Philadelphia Business Outlook Survey as one of the indicators that the marketplace is watching. Because it's viewed as a good indicator, and it sort of moves financial markets when the number comes out. So that's one of the things we do. The other thing we do in Philadelphia is, and this may be useful to you, get a term paper or something. Yeah. We do a survey of professional economists, or a survey of professional forecasters every quarter. So here is a free, publicly available forecast for economic activity in the United States by a variety of indicators, GDP, unemployment, inflation, that sort of thing. And again, the product of the consensus forecast of between 50 and 60 public and private sector economies. So that gets some, those are two things that we contribute to the body of economic knowledge. Other reserve banks do different things. St. Louis has always been much more attentive to measures of the money supply than other reserve banks, and has always done a great job of developing useful measures of money. So, yeah, so different information from different reserve banks. Other things, yeah.
Did all 12 banks have people saying where the bailout money would go and how much would distribute to different banks?
That's a great question. So what about the bailout money and how that's being managed within the Federal Reserve System? A couple of things about that. One is we have to make the distinction between the TARP money, this is the Troubled Asset Relief Program, and Federal Reserve lending. And the reason is because the TARP money those are dollars that have been authorized by Congress to be spent by the Treasury, and that means that represents that's an example of fiscal policy, in the sense that it is taking taxpayer money and expending it for some purpose. So, you know, taxation and spending on the part of government is the purview of the President and the Congress, and not the Federal Reserve. The Federal Reserve, as the central bank, can lend money to various entities, but we are required to make sure that when we lend money, that the loan is fully collateralized, so that we are guaranteed repayment. We cannot put taxpayer money at risk. It's one of the things we can't do. We're just, we don't do that. We're not allowed for the central bank. So we are. So for example, well, let me just say. So we have lent under a bunch of programs to a bunch of different entities. We have lent, of course, as we traditionally do. We lend to banks, commercial banks. I have actually. Okay, let me see. You have to close your eyes so you don't see all the slides going by real fast, or you think it's like a movie or something. I don't know why. There. Okay. So here are the various facilities under which we have lent money recently. When we're talking about the Federal Reserve lending money to banks or other financial institutions, remember that, again, I mentioned that one of the original intents of the Fed, purposes of the Fed, was to create a payment system that works. Another of the original purposes of the Fed was to serve as a lender of last resort. That is to say, to be there as a central bank when other banks needed liquidity. So, and the sense of it was that this would vary by region. So a local bank that needed money to lend to its customers when it didn't have enough would come to us, post some good collateral, you know, post some government securities or post some high-grade bonds or whatever, post them with them, give them to us as collateral, and then we give them money that they could lend out. So the idea was we were the lender of last resort. When they couldn't get money from someplace else, they could come to our discount window, have some of their paper discounted and get the funds they need. So we have always been in that business of lending to banks. And that's done, to answer your question, those decisions for traditional discount window lending, those decisions are made at the local level. So the Federal Reserve Bank of Philadelphia lends to banks in its district, and it's our decision whether or not to lend, and the loan is on our books, and the collateral is with us. So that's traditional lending.
Does that mean that the New York sector has a lot more pressure on that?
I'm sorry.
Does that mean that the New York Fed has a lot more pressure on it than, say, San Francisco?
Exactly. So all the money center banks are in New York, and when they wanted to borrow money, they came to the Federal Reserve Bank of New York. So that's been traditional lending. That's what we do. Discount window lending on the individual reserve banks. That's fine. When the financial crisis erupted, as you know, the Fed created a number of special facilities under which it would lend. And it's become the so-called alphabet soup of lending programs. I don't even know if I can remember all. Here's the first one, the term auction facility. This was just basically, instead of each individual bank coming to their local Federal Reserve Bank and asking for a loan, the Fed was going to auction off big chunks of money to whichever banks were willing to pay the highest rate of interest on it. And it was a way of basically getting more money out there to more institutions without their having to come and ask for it at the window, where if somebody, not physically, but figuratively, if other financial institutions saw one bank coming to the Fed to take out a loan, they might say that bank looks like it might be in trouble. So banks were reticent to come to the window and ask to borrow. So we created this auction, which basically made it less transparent who was borrowing. So we gave them sort of the cover of the auction so they could borrow from us without the stigma of coming to the Fed for money. So this so-called term auction facility, that was our first strategy. And as you can see, it started out basically, this is over the last year or so, but roughly speaking, the numbers didn't change in the early going. We were lending about, call it $100 billion, give or take. It's funny what counts as a big number now, right? A couple $100 billion, come on, really. It's really a big deal, One time I was showing this picture to somebody and they said, so what comes after $1 trillion? What else could they mean? So they mentioned good quadrillion. You're good. See, I didn't know that. I thought it was a zillion. Anyway, so here's this term auction facility. Those loans are on the books of the bank, of the Reserve Bank, where the bank that wins the auction is located. So if banks in the 3rd Federal Reserve District, Philadelphia's district, win some of the money in an auction, then the collateral is held at the Federal, and that bank happens to be in our district, headquartered in the 3rd District, then we hold their collateral and we book the loan. So it's not our decision, but it's ours to administer. Then there are the other programs. So there's the primary dealer credit facility. We're lending money not to banks, but to securities dealers. Here's the loan to AIG. That's the green contribution. Here's the asset-backed security money market mutual fund liquidity facility. This is the one that was created because you may remember that money market mutual funds were concerned about holding short-term asset-backed securities because if the values went down, then the money market fund would break the buck. That is to say, their owners would have an erosion of principal. And so in order to give money market mutual funds the confidence that those securities would find a market, the Fed created this facility. That's the red contribution. And then starting in this past fall, when things got pretty rough in the short-term funding markets, the Fed opened what it's called the commercial paper funding facility, buying commercial paper directly from issuers of commercial paper. And those are the blue bars. All of these colors beyond the mustard colors, the yellow, the green, the red, and the blue are on the books of the Federal Reserve Bank of New York. That program is being administered. Oh, I take that back. Everything except the reds. The yellows, the greens, and the blues are on the Federal Reserve Bank of New York. The red program is being administered by Federal Reserve Bank of Boston. Somebody here is from the Boston thing. I think that was on the Boston funds. So these special facilities have sort of put the weight on certain reserve banks, New York being one, Boston being another. But again, as a practical matter, that raises some issues, which is, as I said, the Fed is not permitted to lend money without adequate collateral. But in the current environment, you ask yourself, what's collateral worth? It depends on market conditions. And you can imagine in a rapidly deteriorating marketplace we've seen lately, some of that collateral may be losing value more rapidly than we expect. So we could be in a circumstance where there are actual losses on some of these portfolios, at least in the short run. And the question is going to be whether the reserve banks will share in any losses that occur. So yeah, there's some issues there. Yes, sir.
So when an institution in your district comes to your window for money and you look at their collateral and see what they have to give, who then, is there somebody that's watching you to make sure that the Philly Fed is, making sure that this collateral is actually not deteriorating as fast as, that's
Right.
true?
Right. So you're raising a good question, and I was a little bit quick to say that reserve banks manage this process entirely on their own. Remember that the reserve banks are under the supervision of the Board of Governors. So we have just like banks have an annual exam by the Fed, reserve banks have an annual exam by the Board of Governors staff. So they're on our case about, that wasn't the right thing to say to the tape. They are watching over us and our policies and procedures. And again, not to be too cavalier about this, the Reserve Banks Act, to some extent, you want to make sure that the standards to which you adhere in one district are matched by standards in other districts. You don't want some banks to be disadvantaged relative to others just because they're in your district and not in another district. So there's a lot of interplay among the banks to make sure we adhere to similar standards. Okay, that's about that. Did you want to use any of the questions in the pile?
Kind of a really nice diverse set here. We've got some that are more career-oriented, some that are more macro-oriented.
Okay.
Do you have any preference for?
No.
Some just about your experience at the Fed, for example.
Oh, okay.
So there's a couple here. Considering you have worked at the Fed for over 3 decades, how would you compare?
Thanks for that. Whose idea was that?
I'll give you the name later.
Yeah.
How would you compare the current crisis to earlier changes, such as the bursting of the tech bubble, 1987, 9/11, etc.? And it kind of related to that is, what are the major changes that you've seen in your day-to-day life at the Philly Fed? So.
Thank you. These are good questions. And actually, so that actually brings me to a point that I thought about on the way over today, and that is, I mentioned to you that there were a number of ironies in the way things started out for me. I was an English major that became an economics major, and switched from the liberal arts school to the business school and all that. And that's sort of its own irony. The other irony is that the only reservation that I had about becoming an economics major, the only reservation I had, honestly, was that there didn't seem to be much left to do in economics. Having taken the course in principles, it seemed like everything had been pretty much figured out. That the government knew exactly how to manage the economy's performance. That by some combination of Keynesian monetary and Keynesian fiscal policy, the economy would always be relatively stable. So really, economics was sort of done. Why not move on to something that was undone? And the reason, the irony of that, of course, is I was stepping into the economics business in the early 70s, just as it turned out that all these Keynesian policies people thought would be so effective in controlling the economy, just as they all began to fail to perform up to expectations. So again, I'm just going to flip back to a few 100,000 charts here. So here is one measure of economic performance over the last 40 years. Slightly before I began at the Fed, beginning in 1959. Song of the year, 1959. Greatest song of all time. Mac the Knight, Bobby Darin. Greatest song. Anyway, 1959 through 2009. So think of it as the last 40 years or so of economic history. Green line, again, real GDP growth. So this 4-quarter moving average rather than quarter by quarter to sort of highlight the cyclical components rather than the shorter run fluctuations. The gray bars here represent periods of recession in the American economy. What you can see is that basically you can divide this graph into, I'm going to call it 3 parts. Oh, and by the way, the solid green line is economic history. The pale line, green line here at the end is a forecast of what's going to happen to GDP over the next year or so. So I'm going to call this 3 parts. The first part is this part, from about 1959, 1960 until 1982, 1983. Just look at that. The second part, of course, is from 1983 until the end of our recent history right here, about 2007, 2008. And then, of course, there's the third part, which is what happens next. And the interesting thing, I think, that you can see here is how different this first stage looks compared to this second stage. When I started at the Fed back back here in the 70s, we were in the midst of an economy that was, by recent standards, extremely volatile. Here I am coming into the business thinking the Fed, that monetary policy and fiscal policy can manage the business cycle. And you can see that the 70s and the 80s were periods in which business cycles, first of all, were relatively frequent. So notice the frequency of recessions here relative to here. They were relatively long, and they were relatively deep. So this is a period in which Keynesian economics was breaking down. And it was only after a change in the way economists thought about the way policy should be conducted as a result of this experience that we moved to an economy that seemed to be more stable. So the second stage is a period in which economic growth fluctuates less dramatically, recessions are less frequent, less longer lived, and less severe than they were back in the 70s and early 80s. So one of the big changes that I saw was that all of those concepts of Keynesian economics that we thought were foolproof turned out to create a disaster, or at least seemed to create a disaster in the 70s and 80s. And there was a real change in the way economists thought about the way policy ought to be conducted. There was much more. I'll just flip ahead here to sort of underscore the chaos. Well, first of all, so this is what happened to real output. Very volatile, less volatile. Here's what happened to employment. Again, the same picture. Much more volatility in employment, much deeper declines in employment during downturns, much more frequent downturns, all that kind of thing, than later on. If you ask what was happening to the other big indicator of economic performance, inflation and interest rates, again, look at the difference between the period prior to 1983 and the period after 1983. The most obvious situation, the most obvious fact is that prior to 1983, both interest rates and inflation were on an upward trend and were extremely volatile. So not only was real activity volatile, not only was employment and unemployment volatile, inflation was very volatile, and it was rising, 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 as were interest rates all through this period. After 1983, a decline in both inflation and interest rates being the orange line here, the Fed funds rate, the Fed's policy rate, inflation being the blue line here. And again, you can see how inflation was declining and relatively low in the last 20 years or so. So very different experience both in terms of output and employment, but also inflation and interest rates. This was an environment in which inflation would rise, and the Fed kept interest rate, would raise interest rates in order to try to bring inflation down, but it would never raise interest rates enough to bring inflation down. And then it would, until it took some dramatic action, like this, and then it would push the economy into a recession. Then the recession would come, they say, oh, we have to lower interest rates. So they'd lower them very quickly, down to the rate of inflation, and sure enough, that would ignite more inflation. And then they'd say, oh, we need to jam on the brakes, and so the economy would go into recession. They'd say, oh, no, we can't have that. So they'd drop interest rates very dramatically. The interest rate swings were too dramatic. They were creating too much volatility in the real economy, but they were too low. They were never high enough to bring inflation under control. So you had what is called an environment in which real interest rates, that is the difference between interest rates and the rates of inflation, real interest rates were never high enough to get inflation under control. So you had this acceleration in inflation through the 70s. And as a matter of fact, that was one of the features that really baffled people who were macroeconomists of the Keynesian ilk. Because Keynesian economics said, you know, if you do the things that will slow the economy down, inflation will be lower. But here's a whole decade in which we have more frequent recessions and deeper recessions, and inflation, instead of going down, is going up. So we had rising inflation as well as declining output growth. Put another way, this is the era of so-called stagflation. And it undermined people's traditional macroeconomics, the Keynesian notions, all the things that I thought represented the solution to the problem. Didn't work. And the change was the so-called rational expectations revolution. You know, this notion that markets are efficient, that basically there's full information out there, especially in financial markets. So, and agents are rational. So what's happening is you let interest rates and inflation move too closely together. People come to expect higher inflation, and that expectation of higher inflation only pushes interest rates up more, and so forth. So there's a sort of a vicious cycle created by expectations. The point I want to make is that the notion was you had to break that cycle of the expectation of rising inflation. That was the way to bring things back under control. And that's what the Fed did in 1980, 81, 82. We raised interest rates well above the rate of inflation and kept them there, so that people no longer expected higher inflation. And because they didn't expect higher inflation, they didn't behave in ways that created higher inflation. So we broke the rising expectations chain. And so inflation came down very dramatically, and inflation expectations came down, and as inflation expectations came down, that allowed interest rates to move lower. As long as we kept interest rates high enough above the rate of inflation, real interest rates high enough to keep inflation from getting out of control again. So the so-called, rational expectations revolution in the theory of economics changed the way in which policy was conducted. That's the point I want to make. That there was an actual, this is an example of actual academic research and thought changing the way real policy is done and having a real effect on the economy. That is to say, creating a more stable environment and a lower inflation effect. It's a pretty impressive thing, I think. Here's the thing. That brings me to stage 3 in the picture. Right now, that doesn't seem to be working so well. So, you know, if you think that you have the timeless truth when you were a Keynesian in 1970, pretty soon the economy tells you you were not exactly right. And if you think a rational expectations approach to monetary policy is a better way to proceed, as we did in 1980 for a while it worked, but you know what? Sure enough, that's not perfect either. So there's no such thing as timeless truth. And we're actually in an environment now, and I'll go back to this picture, where the question is, what happens from here? You know, we weathered this very volatile environment by changing the way we did policy. We created a more stable environment for 20 years or so. But now we're in a situation where basically it looks as if we're headed for a recession as deep as the recessions we saw in the 70s and early 80s, and as long as we saw back in the 70s and early 80s. You know, these recessions, the recession of 1991, the recession of 2001, they were less than a year long. They were about 8 months long. This recession was officially declared to have begun in December of 2007, which means that it's already 13 months old. And most people are expecting the forecast, like our survey of professional forecasters. We ask them when they think the recession will end. They say June or July, which means that it's going to be an 18 or 19-month recession, which makes it the longest recession, actually longer than any in the post-war period. So, post-World War II period. So, so the point I want to make is that a method that, you know, we went through an experience that told us the way we were conducting policy wasn't right. We changed it, and we seem to have generated a better result for the economy. But now, having pursued that policy for a while, it's not so clear that that policy is still working. You know, when we thought people didn't know anything in the Keynesian world, we got a bad outcome. When we thought they knew everything in the rational expectation world, we got a bad outcome. The truth is, as always, probably somewhere in the middle. But we're going to see a change now, I think, in the way, first of all, in the way people theorize about the economy, and then second of all, in the way policymakers conduct it. The long answer to the question, how have things changed in the 30 years I've been at the Fed? They've changed in that, already thinking that we had all the answers, the economy proved us wrong. Then we thought we had the right answers when we reformulated our approach in the 80s, and it turns out now that wasn't the answer either. The good news is I don't have too many more decades to go through before I'm out of there. And other things, I'm sorry, that was one nice question. Other things about the Fed?
I have some kind of career-oriented questions if you want to go with that.
That's fine.
This is a question for you, Ron. These are kind of a broad swath, if you will. There's one question here. I eventually want to work my way to Wall Street. If I were to start my career with the Fed, what positions and career paths should I consider? And the person's interested particularly ultimately getting into like M&A, mergers and acquisitions. And there's a couple questions. One, a person asking about, seems like the Philly Fed has a lot of education initiatives. What groups of people work in the Philly Fed that do that education? Are there opportunities working with educational programs? And the third one, it's not too much for you, so it's kind of finance, it's education, and accounting major ask. I keep learning about, or hearing about, accountants are needed now more than ever before. Where are they needed and how is their expertise to be applied late to this crisis potential?
Okay. Thinking about going to Wall Street in investment banking, or the equivalent, thinking about being involved in education, thinking about being involved in accounting. The first one is interesting. This issue of thinking about starting a career at the Fed as a vehicle for stepping into a career in the financial world, perhaps in New York. That actually was a pretty common model people would start in our supervision and regulation area, and they would learn the banking business from the point of view of being a bank examiner. And then with that background, particularly the knowledge not only of how banks would operate, but also what the Fed's rules were, that would give them a leg up when they wanted to go to a private sector banking organization. In our own district in Philadelphia, it wasn't so much from the Federal Reserve Bank of Philadelphia to New York as it was the Federal Reserve Bank of Philadelphia to Delaware, because there were so many banking institutions headquartered in Delaware, like MBNA, like Discover. They had a credit card operation there. They would scoop up our people. And our people were ready to go because they were trained and because the Fed's compensation was not nearly the equivalent of what they could earn elsewhere. So it was sort of a regular process. In the last, I think I alluded to this earlier, in the last couple of months I have noticed that the flow has more or less been starting to go the other way. People who are losing jobs on Wall Street and in large financial institutions at various stages of their career are asking whether there's room for them at the Fed in the supervision and regulation area, which they expect to be growing. So for example, just this past week, I was talking to some people and a dad asked me if I'd talk to his son. He had just started out on Wall Street at Goldman, and he's out. So he's looking for something in the regulatory stuff. 2 weeks ago, I talked to someone who had been working in investment management for high net worth people here in Philadelphia. Again, trying to find something now on the government side. I've interviewed some people who are more economists than bankers, but what I've learned is that there are a lot of people. These are people who worked at banks, large banks, and one of the things that happens in the consolidations, of course, is that some functions basically can tear down. So if you have two big banks, each with an economics department, and you make one bank out of it, they only need one economics department, so if somebody's out. So what we're seeing is a fair amount of that kind of thing. So again, my point is that the flow of talent, which had been going entry level at the Fed into financial services, now seems to be all levels out there, thinking about trying to get into the Fed. So the flow will change, of course, when the economy does better and the financial services industry does better. But for now, at least, I don't think of the Fed as a place to be from. Think of it as a place you'll wind up in. When it comes to education, I'm not entirely sure whether it was someone who is interested in being an educator or someone interested in getting education. We have at Philadelphia and at most reserve banks, there is some provision for people to continue their education. Most of our programs would not be applicable to people here because you're already getting a 4-year degree from a good school. We have programs that allow people who work for us to pick up college at night. We have classes inside the night and that sort of thing. On the accounting front, there's an area where I really, I know that there's a demand for accountants, and I know that there's going to be an even greater one because there are so many financial assets to be gone through, and we're going to be interested in having people with that expertise. But I really don't know much about the opportunity set for accountants. Somebody said economists are people who like numbers, but they don't have enough personality to become accountants. I don't know if that's true. So I don't really know that much about the accountants. So I don't know if anybody has more specifics about that. Yes.
Do you necessarily need, you need to be a finance major or accounting major to get the Fed? Or the economic major?
Yeah, so it depends on where you want to be in the Fed. I mentioned that we do 3 things. If you want to, the payments business is going to, I'm being sort of blunt here, I know maybe if you oversimplify. The payment system business is going to go away in the Fed. So there's not much there. The supervision and regulation function, as I said, is probably going to grow. Again, people with accounting as a background are probably going to do well, or finance as a background would be the kind of people we'd be looking for. In economic research, it's a small number of people, it's very specialized, so it's going to be basically the entry level. We're talking about research assistants, research analysts, and these are people with, I'm going to call it, they're economics majors, probably either in a graduate program or intending to be in a graduate program. And then we have a handful of PhD economists. These are people who, because of the Fed's reputation, we can basically, and I'm not championing this, I'm just saying it's true, but we wind up being able to tap into sort of the people from the best graduate programs. So that's a pretty rarefied crew. Yes, ma'am.
Do you ever look into undergrad schools as well as MBA programs for accountants or interns or competitions or interns?
Sorry, that's
Do you also look into undergraduate programs for full-time and part-time?
for people to work for us, you mean? Oh, yeah. We would, if what you're asking is, do we take people with bachelor's degrees?
Right.
Oh, yeah, we do. Yeah. The only place where I'd say advanced degrees wind up being sort of being the issue or is in the economic research area. But other than that, I think it's much more. Okay.
It's 5:15. Unfortunately, to end. It's a very nice conversation. Appreciate your time and effort in coming here and talking about students.
Oh, my pleasure. Thank you all.